Good afternoon, ladies and gentlemen, and welcome to the Minds and Machine Results Investor Presentation. Throughout this presentation, investors will be on listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question in the box below and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, I'd like to submit the following poll. And I'd now like to hand over to Toby Hall, CEO, and Michael Salazar, CFO of Minds and Machine. Good afternoon.
Good afternoon, Mark. Welcome everyone to the H1 interim results for Minds and Machines. With me is Michael Salazar, the Group CFO.
Good morning, everyone, or good afternoon. I suppose it's morning for me.
Okay, I welcome both existing shareholders and new private investors who maybe have joined the session. And just to recap, the first slides just are a quick overview of the business, just to put ourselves into perspective, perhaps if there are listeners, viewers who are new to the business. And the first is really what is our goal and what business are we? And to recap, we are a pure play registry. That means we own these 32 TLDs, top level domains. Think of young.coms, and we view them as internet infrastructure. And our goal is to create a very predictable revenue annuity stream off those properties and to thereby creating a SaaS type revenue model for the business. To understand, again, just to look a little bit more into that business model, we have 33 now. The sharper-eyed, we historically talked about 32. The sharper-eyed will notice we now have 33 top-level domains, and we'll touch on that a little later. And we own that infrastructure. All the technical platform that integrates those properties into the World Wide Web, we outsource that to a technical backend, and that is the middle band indicated on the graphic. And then we sell via an automated retail channel in the industry known as registrars. So they are responsible for the selling of our properties. And as I mentioned earlier, the revenue model is SaaS type. An end consumer pays an annual fee, first of all, to acquire their name and then to renew it each subsequent year. And the types of use, email, websites, marketing, and also brand protection, and not forgetting investors. Names are an asset in their own right, and people buy those names in the same way that the public buy, members of the world buy shares. Our asset base, again, same as for those who know the business well, no surprises there. We have a broad range of properties, and they range from specialist sectors such as .law to very generic extensions such as work and .vip, and then those to consumer interest and lifestyle, wedding, fashion, etc. And for the keen-eyed, in partnership, we have taken on a new property called .forum, which is yet to live, and that is an interesting opportunity for us. It's a rev share opportunity. We haven't put any cash down to buy the TLD, and so we'll be looking forward to rolling that property out. It will be a very low registration but high value property as and when it launches. Our geographic spread, by using the external retail channel, we're able to reach a global audience. And again, the map is an update from the map that we provide each half-year period, and plus numbers in each region. This is where we've signed where we've increased the retail partners in the region, and this is important because there is consolidation in our sector, and that is playing out in the registrars. So there are fewer groups, larger groups, consolidated groups emerging, but we're pleased to be continuing to expand our reach in each of the regions. And again, our headcount, we've started some cost efficiency activities, and that number is down. But Michael will be talking about that more later in the presentation. So to understand our business, how we're growing the properties, Mike and I took over the business 4.5 years ago, and really it was a business that was had a great portfolio, but operationally had hit the buffers and was at an operating level, losing a significant amount of cash. And our primary focus was to deliver organic growth. That was a case of selling through the channel efficiently to grow our revenue. And a big piece of work is about improving the quality of our revenue. And this has been absolutely key to our activities in the first half of the year, and Michael will touch on that in subsequent slides. The second piece of the activity is innovation, how we complement our portfolio by creating innovative new services for the future, and as well as selective acquisition. So that is an overview of our business. And I'm now going to hand over to Michael to give some real-time indications of how we've been performing in the first half of the year. And this really picks up on the H1 trading numbers that we shared 8 weeks or so ago. But it's important to understand that picture before jumping into the revenue piece.
Thanks, Toby. So to Toby's point, and we put a trading update out earlier, and what the trading update focused on was more about billings than it was about the accounting revenue. And the reason why that's an important metric, billings are the amounts that we invoice. So that is the amount of cash that we are billing and that are generating by the company. That is a very, very important metric for the company. When you look at things from a revenue perspective, which is in the P&L, we have a deferred revenue model with registrations and may not always give an accurate picture of how the business has been performing. So we want to highlight, and we'll be highlighting our billings and how they progress over time, in addition to highlighting, obviously, the revenue numbers. So on the left-hand side, you'll see that year-over-year registrations are up 31% to 2.4 million, up from 1.8. Billings, which we were just talking about, up 7% to 7.9 million from 7.4. Importantly, in that billings number is that 7.8 of it is from the channel, which means it's an automated sale, which has been the focus of our business now. We have only 100,000 here of brokered one-off sales. So really the focus of the business is to continue to grow the channel billings, because that's the recurring SaaS model that Toby was alluding to earlier. Channel billings up 20%. First year channel billings up 23%. So what does that mean? That means new customers coming in and buying domain names on a first year registration. So that's up 23% to 2.6 million. Renewals are up 17% from a billings perspective, up to 5.2, and cash generation is up 19% to 2.5 million from 2.1. That's cash generation from operations. However, on an accounting side, it doesn't correlate necessarily, and that's because of the makeup of the revenue. Channel revenue is up 4% to 8.3 million from 8. And H1 revenue, however, is flat. It's 7.4. Now, when we say flat, that means after the partner payments. So although we've replaced 900,000 of one-off brokered sales with channel sales, and we still kept revenue flat. So channel sales have grown significantly. Cash generation, again, is the same. We talked about operating EBITDA and profit are down. So revenue was flat. Clearly, that means that OPEX and COGS were up, which I will explain a little bit further below. But operating EBITDA down 15%, which flows into H1 profit down 29%. Although if you look at FinCap's adjusted profit before tax, it's down 4%. In terms of our revenue mix, we've talked about this several times, and we gave guidance in 2016 on how we would turn around the business. And really that was a lot of brokered one-off sales to generate cash for the business, while the business had time to grow standard and renewal streams. So that was the guidance here. Where we're at now at the end of H1 2020 is that brokered sales now represent 1% of our revenue, and what goes through the channel is now 99%. Importantly, channel renewals are 67%. So we would expect to continue to grow that number. On the right-hand side, you'll see the geographic revenue mix. So early on, when we had launched VIP into China, we were heavily weighted, a bit more heavily weighted into the Asia region, specifically China with VIP. With the acquisition of ICM, that sort of balanced things out. And so where we are now at H1 2020 is that there's 20% in the Asia region, 20% in Europe, and 58% in the US. Those are good metrics. I'm not necessarily saying that we're going to stay on that particular ratio, but it is likely that we will stay very close to that. Of course, we will always be opportunistic where there's a potential deal to be done in a region, and so these percentages could vary, but typically they'd stay fairly close to these numbers.
Michael, just before you move on, there was an interesting question on this slide to clarify between first-year renewals and subsequent renewals, and if you don't mind, I'll just quickly cover that off now whilst to save us pulling back. So when we talk about 67% renewals, that of our revenue, that is blended from our first-year renewals and our the renewal on renewal, so the second renewal year and the third renewal year. And it's important to understand that this is an industry whereby typically, if a property, there is no form of promotion around a property and you get a sale, first-year sale, typically about 50% of that those who bought a name would renew at the end of the first year. And then in the subsequent years, what we would see is that number going into the 70%, and in certain properties, even into the 90%. So the renewal, and it increases significantly. And we've seen that consistently across all our properties. So a big part of our work is around how to drive volume, but in a way that both grows the quantum of revenue renewal, the number of renewals in the second year in a quantum, and also that revenue amount. But the percentages might be slightly lower than the 50% baseline number if something's unpromoted. But our goal is to grow the quantum of first-year registrations, renewals, and then likewise get that beneficial uplift in the following renewal years. So I just wanted to interject, Mike. I hope that doesn't trouble your flow, but I saw a question coming in.
Perfect. I'm flexible, Toby. On the left-hand side here, again, we talked about the registrations. You can see the registration growth from H1 of 2016, which is the first half year when we had taken over, to where we are now. So, an impressive growth, and we see that continuing. On the right-hand side, this really illustrates the difference between the cash that we generate, which is in blue. So $500,000 of cash generated from operations 2 years ago to 2.1 last year to 2.5 this year. In contrast, you'll see operating EBITDA go up and go down, again, related to deferred revenue and the quality of revenue and the change in revenue mix. So from 700,000 2 years ago to 2.3. Obviously, it went up to 2.7 last year, down to 2.3 this year. This is just another illustration of the same, of cash flow against profit. I do want to clarify H1 2018. That was really related to the big loss is really related to the onerous contract provisions and the bad debt provisions that were taken during those times. So even though we had a 14.7 million loss from a profit perspective, we still generated $500,000 of cash. And again, 1.2 million of profit, but 2.5 million of cash this year. This slide is a very important slide, and I'll spend a little bit of time here. Cost control, this obviously is where we can control the overall cost of the company. Partner payments, which are payments that we make to certain partners within TLDs for their support for that TLD, are down $500,000 this year, this half year, which really reflects the reduction of the onerous contract. So that which was done in 2019. COGS are up. COGS are up 300,000. Now this is an accounting number, and the reason why they're up 300,000 is we are waterfalling the commissions paid on the adult block sales from Q4 of 2019. I think we highlighted that we did a little over 2 million in billings on adult block in 2019 in Q4, and those are the commissions that are waterfalling in. COGS has increased, not by 100,000, it's actually by 30,000. This is rounding, but COGS increased because of the fact that we took steps to shut down the data center that we had inherited with the ICM acquisition, and then paid severance payments out to the staff. We do not expect that we're going to have 3.2 million double again in H2. In fact, we've always given guidelines that we would be at 6. We're going to be at 6 this year. In addition, we are now taking steps across all three of these, across partner payments, COGS, and OPEX, to reduce costs by over $1 million in 2021. We've already started taking steps now to do that. And I'll give you an example. Currently, we run our 33 or 32 TLDs on 3 different RSP platforms, which is the back end that connects the TLD into the internet. We are now currently in a RFP process. We are getting tenders from a number of RSP providers. The goal is to streamline those processes, streamline our systems, and hopefully consolidate, if it makes financial sense, economic sense, onto a single platform and going forward. So we will be making changes into our back-end infrastructure to reduce costs, and we expect that that's going to be implemented sometime in Q1 or Q2 of 2021.
Thank you, Michael.
With that, I hand it back to you.
Thank you, Michael. Looking at the wider piece, we have innovation and selective acquisition. There has been consolidation in the sector, and we have made acquisitions in the past, and it remains part of our strategy for potentially scaling the business. In addition to that, first half of the year, we have continued to make progress on innovation. And for those who are newer to the story, just the recap, the purpose of the innovation piece is to create relevant value-added services to our existing properties. So it's about, ultimately, of creating revenue opportunities in the near term. And adult block is a very good example of that type of activity. We then have a piece in innovation which is around R&D, and that is where our .locks initiative plays in, and that is about understanding how new technologies that exist beyond the traditional World Wide Web and the DNS, how there is potential scope for interplay and leverage between that traditional World Wide Web world and all the benefits of the World Wide Web provides, which is ease of use, interoperability with the blockchain universe, which has tremendous security and supply chain implications outside of its crypto associations, but is hugely difficult for general users to interact with. So we have a piece which is R&D, and the real premise of .locks is allowing one name, one naming address to exist in multiple environment. So the same address that works on the World Wide Web can also work on within blockchains. And when we launched the project, the association was simply between the World Wide Web and Ethereum, Ethereum being the largest and most used blockchain. And that project was launched 2 years. And in the subsequent period, we have both learned to develop our own technology so that a name can be associated not just to one blockchain, but to multiple blockchains. And in parallel to that, we have now Ethereum has developed similar technology, and we're now upgrading our .lux API to support up to 19 different blockchains. And from a consumer perspective, think 19 different crypto wallets, different token crypto wallets. We're in the final stages of that integration, and we think we have a unique insight, because the Ethereum piece, which is around creating associations just within blockchain, we're bringing in this additional benefit of a World Wide Web usage case. So that project is moving along well, and we expect it to be rolled out to end users in the Asia region in Q4. So moving outside of the innovation piece and the acquisition activity and the organic piece, really we want to provide the interims, provide guidance into the current outlook. And the first thing to really signal is we continue to be H2 weighted, and our channel activity is remaining healthy. And we gave guidance in last week's statement that we expect revenues and operating EBITDA to be ahead of H1. So it's important we have not been impacted via COVID in our core channel revenue. The next piece to cover is what are the factors that might that indicate how far we might exceed H1 performance. And this is where COVID has impacted us year to date. And this relies around our adult block strategy. So I'll pause and just give some context to the adult block piece, and I'm sure Michael will step in as necessary. But when we launched adult block 2 years ago, the premise was a basic one, and that was when we acquired the ICM property, not priced into the sale price, was the fact that when XXX launched in 2011, there were approximately 65,000 registrations of names where companies had blocked the name. So they hadn't registered it on the DNS, that the registry, the TLD operator, had simply blocked the ability of other companies to acquire those names. And they were sold on a 10-year license. And in very simple terms, if Microsoft wanted to protect itself, it would block Microsoft.xxx. And that block was sufficient because at that time, there was only one script, the Latin script, that was recognized on the DNS. In the intervening years, in 8 years, multiple scripts now exist, and it is possible for bad actors and fraudsters to create lookalike addresses that to the human eye read as if it's Microsoft, but it's anything but. It's a combination of different scripts to dupe the internet user, the web user. So the blocking product was developed with a partner, and that is an algorithm that blocks all the lookalike characters from those different scripts, so that to give that additional benefit that not only is the Latin script name covered, but all those variations that can be generated. And to further improve the product, we allow people to upgrade early their single registration into a block across all of the 4 adult properties. So this was a significantly enhanced product, and we launched it 2 years before the natural renewal date in 2021 for the original block, 10-year blocks. And the rationale for that was to test if there was an appetite for this new improved product at the price point. So that it is a significantly increased price to the original 10-year block. And we were delighted that the first mover registrar partners, so that's 65,000, you've got to imagine, there's 65 end customers, but they all interact with ourselves effectively through a registrar. So there are registrars between us and those block holders who effectively manage the sales process. The first movers of those registrars got involved in that launch phase in Q4 last year, and in turn, the first mover base of their client base interacted, and we had, as Michael alluded to, some excellent sales, better than expected sales in that period. The strategy for this year was always to select 2 registrar partners who represented about 25% of the opportunity with their installed base, and to roll it out. And certainly at the beginning of the year, everything was in place for them to roll out in Q2. COVID, however, impacted that, and now we are pleased that they are looking to start their marketing and sales activity to their installed base. The extent to which we generate billings and revenue within this quarter is very hard to determine, because it's difficult to know whether those end blocking registrants are going to go for a 1 year, a 2 year, or indeed a 10-year option. So it's very difficult for us to fix. And as we progress through the final quarter, we will get much better clarity on that, and we can then start analysing how we suspect 21 can play out. But to recap, we are cash generative. We know from our core business will be ahead of what we did in H1. The extent to which we exceed that will be determined by how Adult Block progresses in those final weeks of the year. In addition to developing the business on the ground, we signaled in our interims our capital returns. And here, to recap, being a cash generative business, we consulted with our board, and given where the share price is performing, the view of the board is the most effective way to return value to shareholders was to continue the reduction of our issued share capital. In the year to date, we've taken just under 17 million shares. We bought back just under 17 million shares in the open market, and over the last 18 months, reduced the issued share capital by 2.5%. That activity will be ongoing. In addition to that, we signaled that in November, we will be running a formal tender process to buy back £3 million worth of stock via a tender mechanism. And in addition to that, we've given guidance that in subsequent periods, we will be looking to return approximately 50% of our free cash flow. So these are really expressions of confidence of the business. We know we've been on a long journey over the last 4 years, but we are now in an environment of sustainable cash generation. And as a result of that, where it's free, we will look to return that to shareholders. Throughout all our activities, we will continue to maintain a healthy cash balance. sheet. So Michael, I just hand over to you to run through the financial statements.
Yeah, thank you, Toby. Right, just a few points to highlight here. So we can see that revenue from last year is down by 500,000. Now, again, this reflects the change in the revenue that we have. So brokered sales are down 800,000. Brokered sales, which are one-off, high-valued premium names, are recognized as revenue immediately. So in H1 of 2019, you would have had about 900,000 of immediately recognized revenue. Whereas in H1 of 2020, that's down to 100,000, but the channel increase in billings has partially offset some of that loss. Partner payments down, which we've talked about, and cost of sales up, and OPEX up. Again, OPEX up is 30,000 here for the period. On the balance sheet, just a couple of points here to highlight. Receivables down, which is good. We've collected the monies from the Q4 sales of adult block. There are also some VAT refunds in here, and same with the trade payables. There was a VAT payable, so it's just an odd timing on VAT. But that's one of the reasons why that's down, as well as settling the onerous contract, which we don't have in H1 of 2020. This just reflects the share buyback, so nothing significant there. Cash from operating activities, we talked about 2.1 million from last year, where this shows 2.24. The difference being that the 2.1 removes the funds from the GTLD auctions as well as the onerous contract payment. So on a like-for-like basis, it's 2.1 to 2.5. On the cash from financing activities, of course, under H1 2020, that reflects the share buyback. In 2019, that reflected the payment of a $3 million working capital facility.
Thank you, Michael. So to recap, before taking questions, the main points of the first half is channel billings up 20%, delivering overall billings growth of 7%, with 99% of our revenue and billings now channel based. So that is a big win for the business. Likewise, cash generation, critically, that is a 19% improvement to 2.5 million. It's that cash that allows us to return value to our shareholders. And the capital returns, that is to recap, the 3 million tender to take place in November, and the subsequent ongoing returns of capital, free cash, shall I say, in subsequent periods. So a solid 6-month first half of the year. The financial performance, again, just you can read the slides at leisure, but we just pull out some of the key numbers there. Likewise, operating performance, the message there is around the improved revenue mix and the ongoing control of cost improvement as we move forward in the second half, and more importantly, full year 21 and full year 22. Our current outlook, we understand that we are going to be ahead of H1 in terms of revenues and operating EBITDA. Our ability to outperform that is subject to the delays that we've incurred on rolling out certain initiatives with key marketing partners that were earmarked for this year. But we don't view this as a lost opportunity, just simply delayed. We know that as we move into the final year of the original Sunrise blocks that expire in 21, we will be, and our partners will be looking to significantly mine that opportunity. So in short, a robust operating platform with a SaaS type revenue model, well positioned for future growth. So thank you everyone for listening. And if there are questions, we are happy, Michael and I after a pause to take those questions.
That's brilliant. Thank you very much, Toby. Thank you, Michael. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Toby and Michael take a few moments to review the investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations, and would really encourage you. It is valuable to the company, and we'd be grateful if you could complete that. Toby, Michael, investors had the ability to pre-submit questions. We had just a couple sent in. So ahead of going on to the live Q&A, I thought we could address these. The first one, have you now completed the widening of the Ethereum API to allow addresses from multiple blockchains to be associated into a single LUXE address?
Yes, we covered that in the innovation slide, but we are at the final stages of that integration, of that finishing the widening out of the API. And it's now a question of integrating that, the completed product with our primary retail partner. And we look forward to launching that in Q4 in the coming weeks.
That's brilliant, thank you. And then finally, a question stating, I note the open offer and share buyback as a way to increase shareholder value, but will COVID-19 not offer you additional optionality to grow the business faster through selective acquisition?
Michael, do you want to take that one? I'm happy to take it. Passing the round.
Yeah, I mean, look, I think we were always on the lookout, and we will be opportunistic on selective acquisition. The numbers have to make sense. You know, COVID has impacted some positively, some negatively, but frankly, it's about the opportunity, and it's about the right pricing and the model that we would apply to something versus what the owner of an asset believes it's worth to them. So there is opportunity there. We are exploring opportunities, but I think that's about all I can say at this point.
That's brilliant. Thank you very much. Obviously, if I could then draw your attention to the Q&A tab. Obviously, what you'll see there is the questions that have come in during the live event, the name of the investor, and indeed the question that's submitted. If I could just ask you to read out the question, but even if who it's from, and then give your response where it's appropriate. And obviously, if we don't get to answering all the questions, we can always review them post the conclusion of the meeting.
Yeah.
Yeah,
I might play the game of the question asker and direct them to you, or take them myself. But the first one is absolutely a Michael question. Michael, prior to joining MMX, was with the regulator ICANN, was overseeing the rollout of the new GTLD program. First question Michael has come in is, could you please explain how ICANN impacts your business?
Well, look, ICANN is the regulator of our industry. So all of our GTLD contracts are signed with ICANN. They provide basically the industry policies that we have to follow. We are in constant contact with ICANN. And we just are making sure that we are compliant with all of the regulations. They don't necessarily impact our business in any other way other than the policies they put out and what we have to follow. That's to the most part the extent of it. But we do have a team that focuses on managing our interactions with ICANN.
Thank you, Michael. Next question I'll probably take is, although this is not your domain, do you know what will happen to the .eu domain post-Brexit transition period? I mean, it's a fascinating question, but it's really not one for us to be commenting on. So we respectfully pass on that question. Following question, you said that your sector is consolidating. Why don't you participate to the movement? I would assume the more scale, the better. Yes, selective acquisition is one of our strategies, and continues to be so. But to deliver value, it has to be accretive, and so that is a question of really understanding their numbers and how strong their numbers are before being caught in a scenario where effectively of overpaying and not delivering value to our shareholders. So it is an aspect to our industry, and it is one we're alive to. Can you please discuss the trend in churn first year and on renewal? I believe that question was answered in the session, but thank you for the question. Next question is, why do you label yourself as SaaS, which would assume that a complex software is behind your business? You're talking about properties. Don't you think you're more like an infrastructure real estate owner? Well, we view ourselves as infrastructure assets. So we agree with you. But to understand our revenue model, it's important that the wider market understands we have a renewal fee. It's a renewal fee based model. I think over the years, one thing we have learnt is the sector we operate in is rich and confusing in acronyms and descriptors of businesses, and which are highly confusing to sharp investors. And so, where possible, what steps we can do to help put our industry into context, we found that to be a great help. And certainly, explaining the SaaS model and connecting that SaaS type model, connecting it to our renewal base, has helped, I think, the wider understanding of our business. Michael, I'm going to pass the next one over to yourself. What marketing investment is planned to promote your GTDs and build awareness, both quantum and format channels used, beyond the natural marketing that occurs via presence and channel partners? Should you reinvest cost savings in the properties? Obviously, we can't talk about your future plans, but Michael, within the scope of the question, I'll pass that.
Yeah, the marketing is really with our registrar partners. That's the most effective spend of marketing. It does depend on the marketing partner. We continue to look at the return on investment. How many registrations are we getting? What's the revenue from that marketing spend? What's the forecasted renewal revenue from that marketing spend? And does it make sense to do it? In some instances, with some of the larger retailers, the return on investment is quite hard to see. So we may not spend a lot of money with the larger retail investors. But we do see up and coming registrars that are aggressive in the market, and we may spend some marketing dollars with them. And some of that may be focused on something very simple as to where our name is placed on their page when somebody does a search. It's surprising when you go do a search for your name .tld that the options that come up, that the higher you are, the more likely that somebody may take that as an alternative from the name that they were looking at. So we spend a lot of time analyzing that, and we are working more and more with partners in that direction to grow that. But as with marketing, there's always the law of diminishing returns, if you will, and so that's where the balance is. So should we reinvest cost savings into the properties? Yes, and we do. But again, under the law of diminishing returns, I think there's a cap that we try to stay at, because beyond that, it's hard to see the return on investment.
Thank you, Michael. Another ICANN related question. So keep you on the mic. Can you please update us on your view of ICANN's progress towards the second round?
Yeah.
What do we currently anticipate?
Yeah, so we know that's in progress. We know that they are signaling that it's going to be done in 2 years. I will tell you from my experience at being there and getting the first round launched, when I came in, they wanted to launch within 6 months. We ended up launching 3.5 years later. So there are going to be considerable delays. I know that they want to be aggressive on this, but I think from our view, they haven't completely resolved all of the issues from the first round. There are still applications 8 years later that are within their system and have not been released. We want those processes resolved ahead of them launching a second round, so we don't run into the same issues going forward. So my guess is anywhere from 2 to 4 years.
Thank you, Michael. Will the company remain UK listed given the shift of revenues and business to the Americas market over recent years? It's a good question. Certainly, our focus continues to be on the UK listed market. Final question. Slide 21 shows various measures of cash flow. You mentioned that MMX will be distributing 50% of free cash flow. Please define FCF. Thank you. Again, Michael, I'll let you lead, but the natural caveat is we've indicated that we will be formally defining that phrase. But Michael, over to your turn.
Well, I think that's right, Toby. We have to formally define that. Yes, cash flow from operations is a key metric for that. We also have to look at upcoming CapEx and other expenses that may arise and budget it for. And then from there, we would look at what we expect the free cash flow to be. So that's yet to be defined. But once we have it defined, I think we will give further guidance.
That's brilliant. Thank you very much indeed, both Michael and Toby. I think, as you say, you both answered all the questions that have been received. I think there's one more that's just popped in. I don't know whether or not that was in the previous round. But of course,
there is. Maybe we'll. If there are any other questions,
yeah, we can take those. Absolutely, that'd be great. Perhaps then, Toby, I could just ask you to wrap up, and then, as I said, I would divert investors to give feedback, and I know that's particularly important. So back to you. Thank you.
Well, first of all, thank you, Mark, for hosting the event and creating the opportunity for us to interact with our private retail shareholder base. I do think this is an excellent step forward to be able to see questions with names, and it is something that we are keen to continue doing, and look forward to be able to providing regular updates via this channel over the subsequent periods ahead.
That's brilliant. Thank you very much indeed for updating investors today. As I said, could I ask investors please not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, then the feedback page will appear in front of you. Alternatively, if you selected it by the email that we sent you in the link, then just please log back in and provide your feedback. It will take a minute or two, but it will be very helpful for the company. On behalf of the management team of Minds and Machines PLC, would like to thank you very much for attending today's session. That now concludes the session. Good afternoon to you all.